Hello guys, welcome back with me. Don't forget to like, comment, share, and subscribe. Not so calm before the storm. Readers look at the day ahead in Asia's market from Louis Scope. Investors do not appear to be waiting for the bridge of central bank meetings this week before making moves. While holidays in Tokyo and London may have meant global trading was somewhat subdued, that didn't stop rates from continuing to ascend to new peaks on Monday. The yield on the United States benchmark 10-year note hit its highest level since 2011, touching 8.51%, although it then pulled back. Despite the fresh milestone for bonds, stocks managed gains, with the S&P 500 logging a 0.7% increase and bouncing back after shedding 4.8% last week. Eurozone bond yields also were rising, with the German 10-year yield hitting its highest since June. Investors are greedy for central bank action. The Fed's meeting starts Tuesday, although the big news will come on Wednesday with its statement and Chair Jerome Powell's press conference. A rate hike of 75 basis points is expected, with markets pricing in roughly 1 in 5 hours of a full first percentage point hike. Meanwhile, in Japan, the BOJ is seen keeping to loose policy when it meets later this week, which could further pressure the weakening yen. The currency has recently slid to 24-year lows against the dollar. Focus in Asia on Thursday turned to China, where a decision is due. Benchmark lending rates. It's a Reuters poll. 75% of market participants predicted no change to either the 1-year loan prime rate or the 5-year. Authorities are seen holding off monetary easing in order to avoid more depreciation pressures on the yuan. The currency at a fresh 26-month low on Monday and traded below the psychologically critical $7 level. Key developments that should provide more direction to market on Thursday: China 1-year, 5-year loan prime rate decision, Japan CPI August, Taiwan export orders August, United States housing starts August. Ford sees inflation lifting quarterly supply costs $1 billion. Reuters Ford Motor said in Monday inflation-related supplier costs will run about $1 billion higher than expected in the current quarter, and estimates it will have 40,000 to 45,000 vehicles in inventory lacking parts, which will delay sales. Ford shares were down 4.4% to 14.27 in after-hours trading. The Note 2 United States automaker reaffirmed its expectation for full-year 20 and 22 adjusted earnings before interest and taxes of between $11.5 billion to $12.5 billion, despite limits on availability on certain parts as well as higher payments made to suppliers to account for the effects of inflation. Ford said based on recent negotiations, inflation-related supplier costs during the third quarter will run about $1 billion higher than originally expected. The automaker said as specified parts supply shortage will result in a higher than anticipated number of vehicles but remaining in inventory. Ford said it believes the 40,000 to 55,000 vehicles will be completed sold to dealers during the fourth quarter. Those vehicles are luxury high-margin trucks and SUVs, Ford said. Ford said it anticipates third quarter adjusted EBIT to between 1.4 billion and 1.7 billion for declined to say what parts the vehicles were lacking. In July, Ford said its second quarter results were driven by higher margin vehicles, partially offset by higher commodity costs and expenses, the company said. Ford said then expects commodity costs to rise by 4 billion for the year and add management was actively looking at how to offset surcharging costs. I think that's all from me. Don't forget to like, comment, share, and subscribe.